Did you think you could just move to the UK, stroll through Hyde Park, and leave your Aussie assets quietly sunbathing back home? Think again. Because the moment you unpack your bags and become a UK tax resident, His Majesty's Revenue and Customs develops a sudden, intense curiosity about everything you still own in Australia. Your shares, your property, that managed fund you forgot about, even your dusty crypto wallet. And just because Australia and the UK have a tax treaty doesn't mean they're playing nice. In fact, they barely speak the same language. The exit tax trap. Leave Australia and the Australian Tax Office might hit you with an exit tax, a pretend sale where they tax your unrealised gains on shares, funds, or crypto. If you pay it, Australia resets your cost base. If you defer, they'll tax the full gain when you eventually sell. Seems simple until the UK shows up. HMRC ignores the pretend sale, the reset, the whole exit tax. They just look at what you actually paid and what you eventually sell for. Result? The same gain can get taxed twice, once by the Australian Tax Office and again by HMRC. Even if both countries tax the same gain at the same time, currency swings can sometimes make or ruin your day. The UK doesn't care about your Aussie dollar gain. HMRC wants everything in pounds, and that exchange rate difference can turn a tiny Australian dollar profit into a chunky UK tax bill, or wipe it out entirely. It's unpredictable, and until you run the numbers in pounds, you've got no idea what tax you're really facing. And if you're selling your Aussie home from the UK, yikes. Australia changed the rules. Sell your former home while living overseas. No main residence exemption. You're taxed like a foreign investor in Australia. Meanwhile, the UK gives partial relief if you used to live there. So yes, Australia taxes the whole gain, the UK taxes a slice, but you're still stuck paying whichever country takes the bigger bite. Spoiler, it's usually the Australian Tax Office. And be aware, remittance basis is out. FIG is in. The UK scrapped the old remittance basis in 2025. Now there's the FIG regime, and it matters. If you haven't lived in the UK for the past 10 tax years, you get a 4-year tax holiday on your foreign income and gains, though with added UK restrictions. Sell your Aussie assets in that window, and the UK doesn't tax the gain at all, even if you bring the money in. But miss that window? The taxman's waiting. So, before you sell, ask these 4 things. Are you UK resident this year? Still Aussie resident? Check both. Have you run the gain in pounds, not just dollars? Did you pay or defer the Aussie exit tax? Are you still inside the 4-year FIG window? Because one mistimed sale can trigger tax from both countries. But get the timing right. You might walk away tax-free. When it comes to selling Aussie assets from the UK, it's not just about the numbers, it's about which system you're playing in. And the rules? Brutal if you don't know them, and potentially generous if you do.